So good afternoon all. Thanks for joining me today on this sunny, bright, but very cold afternoon. I would have to ask you if you have any questions, if you could please just pop them in the Q&A box rather than the chat box. I'll be able to follow the questions on the Q&A box if best rather than the chat box, because it can get lost in as we progress. But I hope you've all had a good week so far. And here we're discussing today how we're assessing deals, assessing property deals, what we do within the company sourced when we're breaking down deals step by step. So as I said, if anyone has any questions, feel free to drop them in the Q&A box. Otherwise, we can do Q&A at the end of the webinar, which is great. So sourced, our success so far. Where did we begin? Well, in January 2017, this was the pilot scheme which was launched in the business sourced. That's where we got started to build up a really big franchise company thus far. Swiftly moving on, September 2017, we ran the franchise model, and that's which it was launched. And then we got FCA approval, with funds, August 2018, which was a big winner for us. At that period of time, we were still having a lot of interest gather within the franchise community for our business. 2018, we hit 40 franchisees, and we continue to focus on doing in-house source joint ventures as well and developments. And this was in 2019. So in March 2019, following on from this, Source registered for ISA and pension funds. So for those that want to, invest into the property world from funds that kept in within sourced within ISA and pension funds, there's a means for them to do so with us. January 2020, Source Capital raised about £1 million per month, which is a lot of money that we use to input back into our franchisees, which helps with the peer-to-peer lending for big projects across the country. April 2020, development pipelines, 8 live projects. One of those, which is currently still being built in Manchester. Huge project. And March 2021, this year, Source hit 150 franchisees. It's definitely come a long way. The business has grown. Incredible franchisees across the UK. And 2021, we recently just launched our property app, which is phenomenal. And I'm going to implore you guys to definitely get that downloaded onto your smartphones via the Google Play Store or the Apple Store. You'll be able to download the Sourced app, and we'll go into that a bit more along the way. So at Sourced, we've got 5 arms to this business. We've got the franchisee business, which I work part of, and I will give a brief introduction about myself so you know who is speaking on the other side. But we also have the property, the capital side, which we work very closely with, because Capital is our peer-to-peer lending platform, which we help our franchisees, do projects across the UK. We've got the development section, and we also have the care section, so property for care sector. So an introduction about me. My name is Shopper Aina, and I am franchise support within Source. So my background comes from the financial markets. I've got experience managing portfolios for clients worth 6 figures plus. I've been involved in property investments for about 5 years. It made sense for me to move from one investment world to another to gain more of a well-rounded scope of interest for myself, and just understanding of, the world of investing. You've got the speculative, and you've also got, bricks and mortar investing. So currently building my own portfolio based on HMOs and buy-to-lets across the country, which is growing well. And now I assess property proposals for franchisees and support them in growing their businesses. And there's nothing more than I like, in the morning before 9 a.m., getting a message from a franchisee telling me how they've, secured a deal late the night before. Is such a overwhelming message and experience to have, and just seeing people grow and moving from success to success. So within Source, where did the deals come from? Well, obvious reasons. We've got our franchisee group. We've got lists. So that could be, being on an estate agent listing. And we've also got deal sources in the world of property. Now, lucky for everyone in the world of property and for Sourced itself, our app, we promote a lot of the franchisee deals on the app. So you have clear access to these deals, which we'll go further into more detail about. So Sourced offices, it really just takes around 15 minutes for our Sourced franchisees to analyze a deal, to break down a deal. They do the best due diligence because they've been given the best and the most clear-cut manner, the process involved to analyzing deals efficiently and effectively. Most information is provided quick at fingertips. So again, if you go onto the Sourced app, you're going to find a deal that's being promoted via one of our franchisees, which is clearly broken down, clearly pictured on the app, and you're able to go into detail, message the person that's actually posted the deal so you can ask for more information about it. If more is needed, then it's going to be quick to deliver because the right due diligence has been done from those franchisees. If you have questions, they have the knowledge, and that's what they're there for. And the best way you can get in contact with them, again, via the app, you can really just, one-to-one, book a call with them and go through the property that, is of interest with you. But how do they, what are the key metrics that they use to analyze these deals? One of them, yield, ROI, return on investment, and ROCE, return on capital employed. These are all provided, but we'll go into further detail to explain what these metrics are and how our franchisees and how our business helps analyze these metrics to understand, more about a specific property investment a little bit better. So go into lists now. If you're on a estate agency's listing, you've called them up, you've asked them to put you on their mailing list, and they send you an email with a property in there. You're generally going to have good high level information, which is fine, but getting more information about the property sometimes can be a tough task. You call them up, they're maybe on their lunch break, they ask you to call back. By the time you finally get a call with them, the property's probably been sold. Can take a long time for requests to be actioned if they don't contain all the information you need. It's not at your fingertips. Only part of the information is shown, maybe on the email listing or on the website. And by the time, again, you make, reach contact, you go, you want to do more due diligence, you don't have that provided in front of you straight away. You end up being one person in a queue of many to get more information, especially if you're just, receiving these deals on a mailing list. Another place that you can get such deals are from deal sources. So generally speaking, a deal sourcer will send something like this, a link from a Rightmove property. This looks like a good deal. This is something, you might be interested in. But then as soon as you ask for more information, as soon as you want to do more due diligence, what use class is the property? Is there any planning involved? Are there any stipulations with planning? Then that's when they usually go cold, or they take forever to give you the feedback of answers, because majority of the time with deal sources, it's just a chain. They're within a chain, and it's from one deal sourcer to another, to another, to another. So how are deals presented to you? Who sets the standard? Wherever you're getting a deal from, whether it's a deal sourcer, whether it's from, an agent, an estate agent, or whether it's from ourselves within Source, a franchise. Generally, sources get bad reputation for not being very good, which is understandable because they just give you high level information and they don't do enough due diligence for you to properly assess what is or what may be a good property investment. So start your relationship with scaling in mind. And what do we mean by that? Well, firstly, what is your property goal? What are your goals? Do you have a path or a process that you want to follow? Rather than just buying one buy-to-let, maybe you want to buy, a freehold land and build on it and scale up by, changing a buy-to-let into flats if possible. What are your goals in mind? You have to set your standard high. This will save you long hours in the long run because you know exactly what you want. So you don't have to waste time sieving through masses of information. Now, due diligence takes time. And if someone continually presents deals in front of you, that makes it hard for you to do due diligence, to do the correct due diligence, then they need to really change their format, not you. You should not set, your level of expectation lower to accommodate for what they're providing. Because at the end of the day, money does not grow on trees. We are investing into something so we can, make a good profit, make a good return, however, whatever the time frame may be. But due diligence is the number one, and that is the mindset. That's what we need to have and focus on whilst moving forward. So don't alter your due diligence process. That's really important. Go lengths and in deep depths in order to assess your deal properly and effectively. So this is typically a good example of a deal that a franchisee within Sourced has produced. So you've got the image on the top, the title of the image, exactly what you want, a brief description, and then it goes straight into the numbers, the nitty gritty, what you need. Again, more description and, providing comparables, which is so important, because how many times would you receive a deal from a sourcer or an estate agent and say, this is a great deal, all you need to do is just light refurb and it's going to sell for £500,000. But when you check the comparables, you do the due diligence around the property that you're looking at or that's been presented to you, you can see that within a quarter-mile radius, the last property sold, which is up to a high standard, has only been sold for 350,000. That's a big difference. Those are the due diligence that are important. And this is where the difference when it comes to, finding high level information and finding, people that provide you with proper information about property with the due diligence done. So we've got the image, the title, brief description, the numbers involved, which is very important, the detail, and then obviously the contact information to reach out to the franchisee. Now we have the app. It's really effective, really efficient. You see everything on the app. You can ask the franchisee who is promoting that specific property deal, property investment to you, and you can book a call and ask more questions and do your own due diligence as well. So an overview of what to do when you're analyzing first. And we've got a question from someone. What methods do you use to assess what property you show your franchisees? So we're going to go into this in a bit more detail. So due diligence stage one. What are the strategy that we first start with is, what will help you reach your goal? Because at the end of the day, we can't just drive in a car with no destination in mind. We need to know where we're going. What are you trying to achieve? Do you have the necessary skills to analyze the deal? Can you make the deal happen? Three very important questions very key questions that you need to ask yourself when looking at, any deal in mind. And the numbers, what are the numbers involved? The purchase, the cost, the build cost, the GDV, are there any comparables? And what's the margin? What's the profit margin you're looking at? How much are you looking to spend maximum on the purchase and on build costs? So we'll go into an example of two deals. So one, we've got a purchase and costs, 190K plus 10K, and build cost has been quoted for 40K. We've got a GDV of 300,000 and a profit margin of 60,000. Comparing to example 2, which has a purchase of 190 plus 10K, same exact costings, but when it comes to the build cost, it's double. And we're looking at 80,000K, 290,000 for the GDV, and a margin of £10,000. You're looking at a return of 3.5% compared to 25%. Now, I'm pretty sure that we're mostly going to choose example 1 in this scenario. But a lot of the time, because people lack the right due diligence processes, they go and enter the wrong deals with the wrong mindset because they don't do the right things before they need to commit to a deal, and they end up getting more of example 2 rather than 1. So you can be, that property individual who brags and says, yeah, I've got a lot of property investments, but you're not making money. And it happens time after time after time. And this is where we push due diligence, if not as a mantra within the business, because it's so, so important and so key. For 90% of people in the industry, this is where due diligence stops. You get a few numbers, build cost, GDV, and that's it. And they just commit to a deal just because they're either pressured by a sourcer or an estate agent, or they just pressured by their family and friends because they just want to be that person that has another deal in the pipeline. But it frankly could be really terrible. This wastes a lot of time in the long run. Deals fall out, money is wasted, investors become annoyed, and estate agents lose respect in the process of doing this, because it does affect not only yourself, but also the investors involved, the vendors involved. So are there any red flags? Again, going back to the due diligence process in stage 2, are there any red flags to look for? For example, are there any planning requirements? Are there any stipulations in planning, that you need to be aware about before going into a deal? Are you looking at a piece of land, but it's raised in a conservation area? These are so important to look into. These due diligence processes are key and can really change the whole nature of a deal. Just want to check, can everyone hear me? Yeah, brilliant. Okay. Thank you, guys. Wonderful. Perfect. Brilliant. Okay. Thank you so much. So going back to what I'm saying, red flags, change of use. A lot of people don't know about change of use and use classes for property. For example, if you're buying a hotel and you want to, a rundown hotel, you want to refurb it and change it into flats, a block of flats, for example, are there any use class changes that you need to be aware of? Do you need to let the council know of your plans? These are so important. A cash only purchase. Why is it cash only? Is there an issue for it? Are you looking at purchasing an unencumbered property with no mortgage due to, because it's unmortgageable? What are the processes involved? Again, going back to it, you need to confirm the purchase, you need to confirm the build, and you need to confirm the GDV. Now, when it comes to build costs, this is something that a lot of people struggle with. And you really need to, we always advise franchisees, whenever you're looking at a deal and you're assessing it and you think it's profitable, it needs to be backed by facts, not by how you're feeling or what you feel it should be. So if you have a project that you know you need to get a refurb done on, you need to go to a reputable, contractor, someone that has been in the trade and that can provide you with an official build quote. And you can compare between 2 or 3 others to see if those figures stack up. You can use those numbers, compare it with, the comparables in an area, and plug it into, an Excel spreadsheet and see if the deal makes sense. You can't go look at a property and think and guess how much it would be worth to refurb it, because really and truly the numbers do not stack up in that manner. Thanks for all the questions. Just keep dropping them in the Q&A. I would look through them towards the end and answer them for you. Planning. This is another point that I keep going back to. It's really important. If you have a planning requirement or there is a planning document, then you need to read through it. You can't trust anyone else to do that for you but yourself. You have to go through the planning document, and if there's anything you don't understand, you have to reach back to the council for clarity, because you don't know what may be involved. And a lot of the time you might be looking at maybe a development project and there could be more costs involved. What costs are we talking about? We're looking at the seal or S106, which can affect the financial viability of a deal. And it happens time and time again. Due to poor due diligence processes, people end up wrapped in property deals with no exit because they're unable to exit from a deal profitably because they've not done the right due diligence beforehand. Make sure you go and make note of specific stipulations in the planning have put in place, and speak to the council, clear whatever situation may not be clear to you, and also make note of the dates, because a lot of the time in planning, if you're given approval or a property is being sold with planning approval to you, there is a date. For example, this document or this land has to be built, developed, or started through the development at a certain period of time. And a lot of planning documents have that. So take particular notes of dates in there. Legislation. Again, going back to use classes, it really just depends on the kind of strategy you're going for. So for example, if you're looking at a HMO in a certain area, is there Article 4 in that area? But not only that, because generally people associate Article 4 just with HMOs. But what you need to be asking yourself is, does that Article 4, is it in particularly reference to HMOs? Because sometimes you could be in an Article 4 area, but it's not actually made reference to HMOs. It could be, the aesthetic external nature of a property that needs to be kept the same as well as the rest of the street. So a lot of people get that mistaken. You have to look into the legislation. What licenses is involved? Selective licensing, additional licensing, what are involved? And is if the change of use are allowed as well. So this is going back to use classes again. You need to be on the phone to the council, the planning department, the housing department, and asking these questions. Cash only purchase, what does this mean for me? Does it affect the GDV? Is there an issue that I'm not aware of? You need to ask these questions, because these are all the questions that, rightly so, are part of your due diligence process that you're going to take through the end to ensure that your exit, wherever that may be, whether you're holding a property to make, to enjoy rental profits, or you're looking to flip, at the end of the day, it really does make a difference. Identify what the cost of solving the problem is, and add to the financial background. So your numbers, costs involved, you're looking at cost of the property for obvious reasons. Solicitor fees. Do you have a solicitor? Do you have a quote? Planning fees, legislation, building work, additional costs, maybe additional selective licensing fees, and mortgage application fees. You need to know all the fees involved rather than ball marking, so your exit is of high value to yourself and you're not going to get stuck with a property deal that doesn't work. Ongoing rental. If you're looking to rent a property out, what figures are involved? Rental income, costs, insurance, voids, maintenance. These are all necessary parts of doing your due diligence moving forward. And the benefit of this, going back to the Sourced app, this is where we really break down these points on the Sourced app, and it's noted there. So if you do come across a property on there, you're able to see, okay, these figures provided to me are based on 10% voids, they're based on maintenance of 10%, or planning is needed, planning is not needed. This is the key. So we're going to go through some examples in a minute. And just going back to one of the questions, I think someone popped in the chat box, what are the metrics that we use to analyze a property deal? How do we know, if a property deal is worth it? Someone mentioned, is 20% a minimum figure? 20% is not a minimum figure for anyone in particular. At the end of the day, there's people who look at property deals and will be happy with a 10% return on capital employed. And we will go through these numbers. And there will be people that won't be. But generally speaking, we like to look for property deals with at least 15% above, return on capital employed. And we'll get into those figures and as to why I'm saying return on capital employed rather than return on investment. So just going back to this slide, yield, ROI, and ROCE, yield, return on investment, and return on capital employed. These are three metrics that we use and are very good indicators to compare from one property deal to another, and even comparing different asset classes as well. So are you holding or selling? Are you holding to for rental income? Selling, are you going to use the profit generated from the sale? Some questions that you need to ask yourself: how do you calculate both, or do you even calculate both? Let's look at an example where we use all three metrics and how we analyze them. So we've got purchase costs, a plain example, purchase of 220,000, all other costs 50,000, and a GDV of 355,000. Rental income of 1,200 per calendar month. Yep, plain numbers. Right. When we're looking at return on investment, you need two numbers. And I'm pretty sure majority of us will know this already. We know how to calculate ROI, but we're going to go through it because I really want to just make sure that you understand the difference between ROI especially and ROCE, which is return on capital employed. So, buy-to-let return is the annual net. And I will repeat that, is the annual net rental income. So here we've got 11,420. And the buy to sell return profit generated is 85,000. So if you just go back to the previous slide, if you look at the 22,000 plus 50, and then you've got the GDV, which is the post valuation. So after you've done a refurb, you've bought the property, you've done the refurb, you bought it for 220,000. The property is now worth 355,000, and you sell the property on. So you're looking at a profit of £85,000. Next, we need a total investment. So again, looking at the ROI, so we've got a total purchase cost of 270, which is a £220,000 purchase plus 50,000 for the refurb. And when you're looking at the rental income, the return on investment based on the rental income, you're looking at the annual nets, which is 11,420 divided by 270,000. So you're left with 4.2% return on investment. Now, when you're looking at the return on investment based on selling the property rather than keeping it and renting it out, you're looking at 85,000 divided by 270,000, which you're looking at a 31% return on investment. So when you're going back to the question that was asked, will 20% be a minimum figure? That's kind of a vague question, because it could be in comparison to your rental income, or when you're selling off a property. So these numbers are good overall for comparisons in the property world, and for between different asset classes, whether it's stocks and shares, ISA or whatnot. But not everyone understands ROI and ROCE, and this is where we're going to go into it a bit further. So return on capital employed. These numbers are good for financial comparisons, very good. Your cash from cash investment deal, how much you're putting in, how much you're making back. You can compare the return on capital employed from one asset class to another to see, really how much your money is working for you. The money that you've put in the whole of a deal and the amount that you're getting back. How hard is it working for me? What rate is it paying me at the moment? Is it currently beating the inflation rate that we're hearing in the world today, which I believe is around 6.4%, which is crazy. So work out what you spend. So we go back to this. So return on capital employed, we've got a purchase price of 220,000. We put down a deposit, 25% for buy-to-let property, which is 55,000. The costs involved, 50,000, and our GDV is 355. So, looking at the total costs and the amount for the deposit, we have a total amount of capital employed of our funds in this project of £105,000. Okay, so return is the same for ROCE as it is for return on investment. So if you're looking at the ROCE, return on capital employed, in terms of rental income, we just do the same thing. We have the net annual income from the rent divided by the capital employed, which is 105,000, and we're looking at a 10.8% return on capital employed. That's how much our money is working in this deal. And from profit on sale, 85,000, again, divided by the capital employed, which is £105,000, 80.9%. So looking at 81% ROCE. And that's where it comes between the difference. You're working with the specific amount that you invested in this deal. And that's how much, that's how hard or how good of an investment you're getting back based on the amount of money that you put in. So ROCE is great for comparing investments, as I've mentioned before, whether it's stocks and shares, interest paid on bank accounts and ISAs, which is really low, and other properties from property deal to property deal. And not many people in the industry actually use ROCE, but it's probably a much more better way of calculating how well your investment is over than the ROI, return on investment. Let's just see, bear with me. Okay, good. Just checking that everyone is still available with us here. And yield, when we're talking about yield, discussing yield, it's only for rental income in this situation. So annual rental income, 14,400, which is divided by the price of the house. And you have to remember, this is the value of the property after the refurb. So after the GDV that's provided, after the refurb has been conducted, the valuation, the new valuation of the property is 355,000, and the annual rental income is £14,400. And this is the yield that you've calculated. And yield is good from comparing, again, one property income against another. So what finance options, since we're down this alley of discussing the different metrics involved with calculating and comparing one property deal to another, what finance options are available as well? What do we have? So you've got bridging, which is usually 70%, a bridging loan, 70% of the value of the property, not the GDV. We've got peer-to-peer lending, which we provide in-sourced, in-house peer-to-peer lending for our franchisees only, which is 70% of the GDV. So going back to the previous example, you're looking at getting 70% of the GDV of the post-valuation, which in sometimes, depending on the deal, can really cover the purchase costs and also the refurb costs. And obviously you have the JV, which is negotiable. And here at Source, we also have that opportunity, and we provide that opportunity to joint venture with our franchisees on certain projects. So long-term finance, you have residential mortgage, 75% typically of the purchase price. And then the commercial mortgage is usually multiple of the gross annual rent. So will you use short-term finance for original purchase and the build, and then refinance using the higher valuation? So this should release the money that we've put into the deal and therefore provide us with a better return on our cash. So we'll go to this a bit more. Whether keeping or trading, we need to show how this all fits together. And again, I keep highlighting this. The way our franchisees analyze these deals, the way they look into it, the way they do their due diligence, they ensure that the amount of money that they're going to put in a deal, and they're going to come out with an exit plan, with a specific exit plan, and make sure that, it's not a fairy kind of idea or guess in terms of valuation, but they're going to ensure that the numbers are backed up by facts. And where do you go to get those facts? You go getting a method valuation, going to the council to ensure that, planning is assured for a specific project. You have to do the due diligence. Everything always goes back to doing due diligence. So going back to the previous example, we're going to use how financing can come into play. So we've got a 22,000 property purchase plus 50K costs again, which is our total of 270. The GDV is still 355,000. So based on peer-to-peer, we're looking at 70% of the GDV, which is 248,500, and 21,500, which makes up the rest of the deposit needed for this property. At stage 2, we're looking at paying off the charge, but we're going to keep it simple. So, you've bought a property cash through peer-to-peer lending. Now you've conducted the refurb. You're now looking to exit. You now find a mortgage that's going to provide you with a 75% loan to value, or £266,250. So that's how much, that's 75% of the GDV that you're being provided with. You pay off the initial charge, which leaves you with 17,750 profit at this point. And then you now pay off the rest of the amount that you've left in the deal. So after you've done all the maths, you're actually only leaving £3,750 in the deal. And if you're calculating, this is where going using the metric of ROCE is really important, because if you're calculating the rate of capital employed, so in total, the amount of money that you've actually left in this deal after the refurb, after paying off the peer-to-peer loan and all the fees, is £3,750. So we can now calculate our ROCE, return on capital employed, on this figure. So going back to the rental income, 11,420 divided by 3,750, the amount of money we injected in this deal, we're looking at a 305% return on capital employed, which is phenomenal. Staying on this path of renting out a property, doing a refurb, renting it out, what other kind of, or what further due diligence can we do, or should we do? The demand in the area. Have you checked the demand? What does spare room say about the amount of renters compared to the amount of properties available in a certain area? Are there any sales statistics, rental statistics? Within your due diligence for voids, if your property is located in an area that has a low amount of renters available, statistically, do you have to account for larger void periods? Have you spoken to estate agents to give you kind of a good basin around the area? These are all the questions that we need to ask. Now coming to the deal calculator. Previously, I mentioned that, when our franchisees are analyzing deals, it typically takes roughly around 15 to 20 minutes at max to analyze a deal and to look through deals, because we have an inbuilt spreadsheet to calculate how profitable our deals are. And this is something that is only, used within our franchise business for those of us within Source. And it saves so much time, so much energy, whether you're purchasing through peer-to-peer, mortgage, or cash. This deal calculator is really what saves a lot of times, because you input the numbers necessary, whether it's the price, the valuation, all the costs involved, the GDV, and it spews out the right metrics. As you can see here, the profit on sale, ROCE, return on investment and profit, and the same for renting out. This is probably one of the biggest gems we have in Source, but it's just absolutely brilliant. And it allows our franchisees to just go ahead, analyze deals very effectively. Once they've done the due diligence, they put the numbers into the deal calculator, whether it's a deal they're looking to do themselves or whether they're looking to market the deal, which they can do through the Source property investment app. It's a wonderful tool. So now we're on the app. If you haven't already, I would highly recommend you all to download the app, Google Play or Apple iStores. The sole purpose of the app is just to simplify the process of sourcing property deals, profitable property deals, making it, very an enjoyable experience. Because at the end of the day, you don't want to just get deals and you won't be happy with if you're being presented a deal and the experience of being presented that specific deal is not great, because even if it was a good deal, you probably won't be interested in actually looking at this deal. The app is just a beautiful place where it just puts all the deals across the country in one place, and you have direct access to these franchisees who are marketing these deals and who can really just go through the whole process one-to-one basis and explain further to you, what the deals are really about. You can message them in the app, you can save it, archive, it's phenomenal. Browse newly added properties and swipe right to save your favorite. The financials are tailored to each strategy. You will be able to immediately see the essential financial details in the app. The description is clearly there with beautified pictures as well. So the whole experience is just phenomenal, and you can ask questions and call up and email as and when you see a property deal that makes sense for yourself. Additionally, what other features do we have in-house in our Source franchisees, for our Source franchisees? We've got Escudo links. So these are pre-qualified leads that our algorithm made from our head office have provided for franchisees. So you get leads based on, your franchise area of deals, whether it's a rent to rent, buy to let, whether it's a planning lead that's just, fallen through, whatever it is, you can actually filter for these type of leads and you get them firsthand. Franchisee then do more due diligence. Once they have those leads fall through, they need to get the numbers correct because it's so important. And then the opportunity, whether they do the deals themselves or they provide it through the app, the opportunities are always available for everyone to enjoy. So some of the app features, we've got the smart search, making it easier for you to assess and find the deals that fit your criteria. We've got the swipe right to save your favorites. We've got faster due diligence because in-house, we know that our franchisees, and we trust them to do the right due diligence to market the information to those that use the app. And more especially, you have direct messenger to the person that is selling the deal, which is so important. You don't have to email, you don't have to wait hours, wait days, wait weeks before you get a response. You have direct access to them. And essentially the content hub. So lots of property deals, lots of content on there that you can sift through on a day-to-day basis. So as I said, be the first, download it, Apple Store or on Google Play. This is the best way for you to actually have first-hand access to these deals, which are marketed on a daily basis for your benefit. Thank you very much for your time. I hope I didn't rush through that too quickly, but I'm going to leave the floor open to run through some questions. Okay, so if you could please just ask your questions in the Q&A box rather than the chat box, that would be great. And yes, the slides are available. It's recorded, so they will be available to all personnel. So we've got one question. I'll start from the top. What methods do you use to assess what property you show your franchisees? So again, going back to what we were talking about before, we look at the metrics, we do due diligence. So firstly, one of the parts of the due diligence is ensuring that we know everything we need to know about the project. If it's a refurb project, do we have facts? Do we know how much the refurb is going to cost? We go out to different, get official build quotes or refurb quotes from contractors or builders who can provide us with a figure, so we know where we can estimate or where we can kind of use that figure for refurb to kind of give us our end product, end value, and base our analysis on the ROCE, the return on investment, and the yield where applicable. So that's how we can judge how we assess our deals, whether a deal is right for us as investors or for someone else. So if someone comes along, an investor says, what, I'm only looking for deals that provide 20% return on capital employed within a specific area, that makes it easier for the franchisee or whoever it is that's looking to source deals for that investor, because they know exactly what they want and they can now start to analyze and do the due diligence to provide them with deals of that certain criteria, be it 20% or 15%, whatever it may be. So again, will 20% be a minimum figure? 20% is not a minimum by any means. It really just depends on the type of deal that you're looking at. Because at the end of the day, you can have a 7% return on capital employed or ROI on the deal, but you're making £20,000 per month. It really just depends on the deal. Really struggling with build costs being so high. Yep, that's definitely correct in this marketplace. That and land, and then a lower resale value. Very tough to make a deal stack up, especially with source finance. at 12% plus 5% fees. That's 70% in total, unless I'm missing something. So I'm not too sure the question you're actually asking, Tim. So if you can just make that a lot simpler, then I'm happy to answer that. Or if you want to give me a call afterwards, then we can discuss properly. So if you're interested in the franchise, I'll just employ you to send an email. And you can send an email to myself, which is shope.aina@source.co. And I would happily put you in the right parties. So let me just okay. So the slides will be emailed out. If you don't get an email for the recorded slides afterwards, please feel free to contact myself or any member of the team at Sourced, and then we'll provide them for you. Do you have to be a franchisee to purchase property from Source using the app? So thanks for the question, Jen. No, you don't have to be a franchisee. You can just be an investor who's interested. So the app is there, it's global, it's worldwide, so anyone can tap in and enjoy the whole experience of it. And if you have any questions, you on any property deal that you come across, you can just directly message the franchise owner of that deal. I hope that helps. Any role for an investor to JV with an experienced developer within Sourced who has no development experience solely to invest all the money? Yeah, of course. I mean, this is one of the another things that we have, or the other opportunities. There's a lot of franchisees. We've got a handful of them that don't have experience but find really wonderful development deals, and they can JV with Sourced, where we would provide the experience, provided the manpower to drive that project forward, and you can actually go through those processes and learn along the way, so you can also enjoy the outcome of the project, but you're also learning, so you too can be that experienced developer moving forward. But there's a lot of opportunity there, and if you do want more information about that, please feel free to contact me or contact someone in my team. Are all deals going through the app? So yes, all our marketed deals are going through the app, and I believe they are also marketed on our website, but we're using the app mainly. So all the deals that you want to see or assess, I would advise you to do so through the Sourced app. How do you assess the GDV or the right purchase price for HMO, as it is hard to find comparables? Yeah, so this is a good question, Irene. It can be very hard to kind of assess the GDV for HMOs, because obviously if you're purchasing one in an area where there aren't any other HMOs, sometimes you can use the annual rent. So for example, if a HMO is producing, let's say, £20,000 per month annual rent, then if you multiply that by a factor of between 8 to 10, that sometimes can give you a good region of how much a HMO should be worth in a certain area. But that really just depends on the amount of rooms that specific HMO has. If it has 3-4 rooms, it's most likely that you're looking at just a basic bricks and mortar comparable based on the houses on the street. But if you're looking at 7, 8, 9 bed HMO, then most likely it will be best to use similarly an annual rent on that occasion. I hope that helps. Where do we access slides? So the slides will be emailed to everyone. If you don't get any access of the slides, then just feel free to contact myself or anyone in the team at Sourced, and they would get that sent out to you. How do you become a franchisee? Yep. So again, you can contact myself or anyone in the team at Sourced, and we will direct you to the right parties. So for Samira, I've just sent across my email address, and feel free to get in touch with me. Ian, yes. So we will send the recording automatically to the email addresses. That's correct. What are the general terms for JV with source? So good question. Firstly, the JV has to be obviously profitable. If you're not sure if the deal is going to be profitable, then that's where you can reach out to ourselves and look at how can we make this deal profitable? Is it profitable enough for source? There's not a specific number to give you that I can say, this is the only reason or the terms for a JV. It could be a vast array of opportunities, but as long as the deal is profitable for both parties, then it's highly likely that there will be a chance of getting a JV opportunity. So I hope that helps. So Ali asked, is there a way to optimize how quickly we hear back from the investors after a property has been marketed? Sometimes a deal, if too good to stay on the market too long, and by the time someone shows interest, it's already gone. Okay, good question, Ali. I mean, it really just depends on the investor that you get in touch with. So if there's no specific way to get the investor to contact you any faster than they would because they have access to you directly, but we'll look at more ways on how we can develop that and make it more efficient for yourself. So thanks for sharing that. And if there's any additional questions regarding this, if you could send me an email about this, that would be great, so we can look into it further and I can discuss that with you. Please email me recorded webinar. Yes, sure, no problem. I think I've dropped my email in the chat box if you haven't seen, but I believe if you should get the email, the recorded email via email. The recorded webinar via email. Okay, do you have a back of envelope rate per meter squared build costs? So this was asked by David. So yep, good question. We use typically, further down in the south, we would say we're looking at £2,000 per square meter for build costs. And typically further north, we're looking at around £1,700 per square meter. So I hope that answers your question, David. It's again, with the current climate conditions, build costs are rocketing. So don't be surprised if you see build costs, north of those figures, but it's a good ballpark place to kind of find out, what you're looking for to calculate if you're going to try to do like a high level due diligence process there. So I hope that helps, David. So Don, usually when it comes to refinancing, the lender looks at past sold prices. So if you have bought a BMV below market value, then you may not get a higher valuation than that you thought the GDV would be. Okay, so I'm not sure what the question here is, but what I can say to that is, if you're looking at a property and let's say, again, below market value, you're looking to do some work and raise the value. Firstly, obviously, past sold prices within a quarter-mile radius. If you see that, or half-mile radius, if you see that like-for-like property comparable is way above the property that you've bought, that's a good indication that you should be looking at getting that GDV. If you want to go further step from there, then you can now get an official valuation to actually get that back. So when you go through, when you're actually doing your process, your due diligence in the beginning, you would kind of expect that the valuer would give you an idea of what to expect post, and they can also give you a value of the property now as well, but you would already know that based on the purchase price. So I hope that kind of helps. I'm not too sure what your answer, your question was, but yeah. Thanks, Helen. I'm glad that it was a great webinar. Thanks, Richard. Thanks, Ali. Yeah, so T Hollywood Escudo leads. So essentially, Escudo leads is an algorithm that we've generated in-house at Sourced, and essentially, where you have a franchise. So, for example, if you have a franchise in, I don't know, central London, you can set based on your portal at Source, you can set your algorithm to allow you to receive like rent to rent deals, planning leads. So these could be leads, maybe a deal that has gone through planning, it's got official planning approval, and it's just looking to be sold. It could be a HMO, it could be a refurb deal. So they basically get sent to our franchisees, and when they open up their portal, they see all the leads there, and they can now click on a lead if it's a rent to rent lead, for example, and they can now do due diligence, call up the agent or whoever is actually presenting this lead, wherever it's been drawn out from, and you can now further look into that deal to see if it's viable for yourself to execute or to actually pass on to an interested investor. So I hope that helps. So Shalom, you want to contact me? Yeah, brilliant, no problem. I will send you my email now. Just bear with me. It should be in the chat already, but I would put that through. So anonymous attendee, how does your application differ from other applications? Okay, app differ from other apps. Well, I've only used a few property apps to be honest with you, and using the Sourced app, I would say it differs for two reasons. One, because of the speed and efficiency and the experience that you have with it, using it, and two, because you have direct access to the franchisees who are selling those deals off. So the added benefit is generally you come across a property app and it's just basically leads from Rightmove or leads from Zoopla. With the Sourced app, you're having leads, property deals that have been, extensive due diligence has been done. It's been broken down, the financials are there, and as soon as you message whoever is marketing that deal, you have direct access to them. So it's more of the experience, I would say, with the app. The whole process is there. You've got good due diligence on the app. You've got a good experience of using it because it's user friendly. You've got direct contact with the person that is selling the app, selling the property deal. Most likely, that's going to be within a franchisee that's going to be within a certain area of that deal. So they really they have extensive knowledge about the property deal, and then you can ask direct questions, you can liaise with them, you can meet with them and speak to them, making that whole journey, that whole purchase journey from the beginning to end a lot more easier for yourself. So I hope that helps. What is the reservation amount? Reservation amount really differs. Typically, I believe would be around 1.5 to 2% per deal. Really just depends on the deal, but the app has everything on there, and you can message the person promoting the deal to you, so you can ask them specifically how much is the reservation amount, and I'm pretty sure it would be stated on the biography of the property that you're looking at. And the time score, again, it really just depends on the deal and the person marketing the deal for you. So you can just you can definitely just ask them there via the app. So the JV is for franchisees only. Yes, that's correct. You can only JV with franchisees. We can only JV with franchisees within the business. Yep, I will send my email to you. Just bear with me, David. Yep, you would receive a recording via email. Brilliant, thank you. No problem at all, thanks. Do you effectively require red book valuation on a proposal? So if you're looking at a deal, and let's say, again, going back to a refurb, for example, if you're looking to present that deal to us, to see if we want to, joint venture it, or you just want us to, analyze it for you. At that stage, you wouldn't necessarily need a red book valuation, so to speak. It would obviously, we'll use comparables and we'll figure out an estimated figure of what that project may be. But obviously, if we're going, if that project is looking to be done by a joint venture or through peer-to-peer lending, then an official valuation would be done at that stage. But in the beginning stage, a valuation is not necessary. So I hope that helps, David. Oh, brilliant. Thanks, Michael. I'm glad that you're enjoying it so far. Yep, got some emails. So how would I be able to get my seed capital back if there are not many properties being bought apart from mine? Okay, Don, I'm going to ask if you could email me. I think it would be better if we have a phone conversation, because I'm still not too sure about what you mean, if you don't mind. So I've just sent you my email. If you just can drop me an email and then we can have a phone conversation, that would be a lot better. Thank you, Paula. Thanks, Don. Appreciate that. Yes, sir. I'll send you my email now. Just bear with me. Kanza, yep, my email. I will send that across. Okay, I will put my email in the chat box. I think that'll probably be easier. Not sure if everyone is not able to see it. Okay, so if you need my email address, it's in the chat box. The deal calculator, unfortunately, cannot be shared unless you're a franchisee. So the deal calculator is in-house and it's only shared with franchisees. Brilliant. I'm glad you enjoyed it, Ronald. Hi, Meher. If you want any questions about the franchise itself and getting it, just send me an email or I will put it in the chat box again, because for some reason, not everyone can see it. Just to make sure, can you all see my email in the chat box? I'll just check if I put it up. Bear with me a minute. Okay, so I didn't actually add it. No, okay, so let me. Yep, that's the one, Meher. So shope.aina@source.co. So SHOPE.AINA@source.co. Let me try that again and share it for everyone. How about now? Can you see it? Okay. I'm just going to type it one more time because Don, I don't think you can see it for some reason. Yeah, brilliant. I'm glad. Perfect, perfect. Okay, I believe we've source.co. There's no .com, not .co.uk, just .co. Brilliant. It's been lovely to have you all today. If you don't have any other questions, feel free to drop me an email and we will speak further. But yes, you should receive the recording within the next 24 to 48 hours, hopefully via email to yourselves. Thanks for your time, everyone. Have a good day.